My name is Mike Morey with Raymond James Financial Services based in Omaha, Nebraska. Our firm name is Morey & Quinn Wealth Partners. Today we're going to spend some time going over the financial management seminar to discuss some fundamentals of retirement planning, some roadblocks that might get in your way to that planning, and the different investment vehicles that we could use in order to help fund your retirement. So why is this important? Well, statistics show that 40% of U.S. workers have saved less than $25,000 for retirement, and 29% have saved less than just $10,000. That's not going to cut it. So we as individuals have to take steps necessary in order to help fund our own retirement, because Social Security alone will not do it. So let's go over some of the roadblocks that are impeding us from funding our retirement. The first one is just a fundamental failure to plan. 42% of workers have tried to determine a retirement savings target. 42%, that's unacceptable. And on top of that, 58% of workers have no idea how much funding they need for retirement. They simply just don't know, and they've failed to plan. The next roadblock is a lack of financial knowledge. They simply don't teach finance and economics in school. Many of us don't have the knowledge of how to get a mortgage, or how to balance our checkbook, or what a stock is, or what a mutual fund, an IRA, Roth Ira. The list goes on and on. We just don't have the knowledge. So hopefully that's why you're here today viewing this, to gain some knowledge to help you towards your retirement goal. The third roadblock is the rising cost of living, or in other words, inflation. Some inflation is good. It means there's a healthy economy, things are progressing along. We've also seen periods of deflation, which isn't good. But in a nutshell, inflation is the erosion of purchasing power. You'll see here that with a base rate of inflation of 3%, a car today that costs $50,000 will cost over $90,000 20 years from now. That is the erosion of purchasing power. So we have to make sure that our money and our investments are keeping up with and outpacing those effects of inflation. You can see this in everyday walks of life too. The cost of a home increasing, or the price of a gallon of milk at the grocery store increasing. That's inflation. The next slide shows the impact of inflation on your net worth. Let's assume today you have $1 million in the bank. That's great. But unless you're investing that money in order to keep up with inflation, that same $1 million 20 years from now would only buy you about $550,000 worth of products today. So again, we need to make sure that our investments are keeping pace with inflation to make sure that they can still buy what we need them to buy in the future. And this takes us to the rule of 72. Some of you might know what the rule of 72, you might have learned it in school. But essentially, the rule of 72 helps us determine what rate of return we need in order to double our money. And for the sake of inflation, let's just use 6% to start with. That's a little high for inflation, but for the sake of this model, if you take 72 divided by 6, the rate of inflation, that means that the cost of living will double in just 12 years. Now let's make it a little more realistic. Historically, the rate of inflation has been around 2.5% to 3%. With a 3% rate of inflation, 72 divided by 3 is 24. That means that in 24 years, at a rate of 3% inflation, the cost of living will double. And most of you, hopefully, will have at least 20 years into retirement, and you need to be prepared for that rising inflation and the cost of living to double throughout your retirement and the rest of your life. The next and fourth roadblock is the burden of taxes. Now, I don't know about you, but I don't like having to pay more taxes than I need to. So I would encourage you to, if you use a CPA or an accountant, just to make sure that they're qualified. If you're doing taxes yourself, using TurboTax or some other software, that's fine. Just make sure that it's up to date and the most current version, because we all know the tax code changes seemingly every single year. But even with those tax code changes, historically, Americans spend or pay about the same rate of their household income on taxes. The average American works from January 1st through mid-April just to pay for their federal, state, and local taxes. And historically, the taxes paid as a percentage of household income has hovered right around 30%, regardless of who's in Washington, regardless of who's in the White House, regardless of the change in tax code, it's hovered right around 30%. And this next slide is one of my favorite examples here. It shows the impact of taxes and inflation on your investment. So let's just theoretically say you have $10,000. You went to the bank to buy a CD, and that CD in a good day would pay 4% on your money in 12 months. So at 4%, after 1 year, your $10,000 has now earned $400. Not bad. Then let's assume you're in the 32% federal tax bracket. So after taxes, your $400 is now worth $272. You're still ahead. So your net after-tax investment is $10,272. Then we take into account 3% inflation. That's about $299 of your earnings. So your net return after federal taxes and inflation is actually $9,973. You've lost money. So this is a good example of just showing that there's no such thing as a risk-free investment. Even FDIC-insured CDs have a risk of a loss of purchasing power. The final roadblock is procrastination. I'm guilty of this just as much as anybody. When we're young and we're in our 20s, things seem a lot more important than saving for retirement. We all have bills to pay. We all have mouths to feed. You might be paying off student loan debt or credit card debt. That's fine. It's still vitally important that you don't put off your retirement savings any longer. Even starting with something small can pay huge dividends in the long run. I always tell people, start with something, pay yourself first. Start with an amount that you're comfortable with. And then after 6 months or a year, bump it up 1% or whatever you're comfortable with. You can always change it. But my guess is after a year, 5 years, 10 years, you won't even know it, but you'll have quite a nice nest egg built up already. There's an old Chinese proverb that says the best time to plant an oak tree was 20 years ago. The second best time is today. So whether you've started or you've put it off, the important thing is do something now. This next slide shows the effects of procrastinating. It takes Bill and Mike and compares their situations. Bill starts saving $500 a month immediately. So after 5 years, that $500 he puts away is now built up to $36,750. Mike, on the other hand, put it off. He procrastinated and waited 10 years. After 10 years, Bill's savings is now built up to $91,450. After 15 years, his savings are now $173,000. And after 20 years of simply saving $500 per month at a rate of 8% return, Bill's nest egg is now nearly $295,000. Now let's look at Mike, who waited 10 years to start. His nest egg after 20 years is just $91,450. That is the price of procrastination. So again, whether you haven't started yet, you're well on your way, the important thing is do it now, start small, increase it as you go. You'll be thanking yourself for it down the road in retirement. Now let's take a look at some of the harsh realities of retirement in today's world. A recent survey has shown that 39% of workers are not currently contributing to their 401ks, IRAs, or other retirement accounts. 16% of 401k plan participants have outstanding loans. 35% of workers have cut back on their household spending. 11% have postponed plans to retire entirely. And 58% haven't calculated how much they'll need to live comfortably in retirement. Again, simply haven't planned. So what is retirement? What does retirement look like? It's not our grandparents' retirement anymore. People are becoming more active. 28% of retirees report that they have worked for pay in retirement, whether that be by choice or because they have to. 80% of pre-retirees plan to work during retirement. A lot of people these days want to stay active during retirement, and one way to do that is to finish their career and then perhaps find a part-time job that they really enjoy, that it's not so much work, it's just to help keep them active and bring home a paycheck. So what do most people plan to do in retirement? Well, 67% travel more often, 58% spend more time with family, and 49% anticipate pursuing hobbies that they didn't have the time or the capabilities to do while they were working. So, during retirement, what are we spending our money on? What are the largest expenses? A recent survey has shown that 18% of our spending goes to housing, whether that be rent or mortgage payment, or perhaps a retirement community. 14% spend it on transportation, and we spend about 13% of our income on healthcare, and this is a rising concern with the rising cost of healthcare. So that brings us to, are you prepared for the cost of healthcare during retirement? The estimated amounts that a 65-year-old needs to cover medical expenses during retirement are high, and they're growing higher with the rising cost of healthcare. A 65-year-old male is expected to spend over $144,000 on healthcare costs during their retirement. A 65-year-old woman is expected to spend $163,000 on healthcare expenses during retirement, and a married couple is estimated to spend over $300,000 on healthcare costs during retirement. So are you prepared for that expense? This might be a conversation where you discuss long-term care insurance. Not everybody needs long-term care insurance, but you ought to have a conversation about it and decide if it's right for you. They can really help out with those unexpected medical expenses, because as we've seen, during retirement, almost 1 in 2 people spend some time in a long-term care facility, whether that be a nursing home, a retirement home, maybe a rehab facility for a hip replacement or a knee replacement. But the percentages show, more often than not, we'll spend some period of time in a long-term care facility, and we need to be prepared financially for that. The longevity risk, will you outlive your money? The life expectancy of a 65-year-old man today is 84 years old. And a healthy male who's 65 has a 33% chance to reach age 90. Conversely, a woman has a life expectancy of 86.6 years, and a healthy 65-year-old has a 44% chance to live to the age of 90. So again, we need to make sure that we will not outlive our money and take the necessary steps to create a nest egg and invest it appropriately in order to have those funds available for us throughout our lifetime. Now let's look at the cost of retirement in real dollars. It's estimated that we will need approximately 80% of our current annual income to live off during retirement. So let's look at this example. Let's assume that your current annual income is $70,000. Well, 80% of that is $56,000. That is what you will need per year to live on in today's dollars during retirement. Based on your $70,000 of annual income, your Social Security benefit could be estimated at about $24,000 per year. If we take your annual income that you need of $56,000 minus your estimated Social Security benefit of $24,000, that tells us that we still need to generate an additional $32,000 to meet our income needs during retirement. The question is, where's that going to come from? After Social Security, we still need an additional $32,000. If you multiply that by the inflation factor based on 3% inflation, your future additional income required is almost $50,000. If we then move to the future additional income of $49,856, multiplied by the income generation factor of 14.0939, it estimates that our future retirement cost will be $702,665. That is the nest egg that you will need to have built and saved up by the time you retire in order to fund your retirement based on your cost of living. So, let's assume that up to this point, you've done some saving and some retirement planning, and you have $150,000 saved away in some form of retirement savings. If we multiply that by the investment growth factor, which is based upon an annual rate of return of 7%, the future value of your current savings is $413,850. If we go back and remember, we need a nest egg of $702,665. We take that, subtract it by our future value of our current savings of $413,850. That tells us that we still need to save $288,815. Again, if you haven't started, if you're well on your way, now at least you know what your target is, what you need. You have a bogey to chase after. So, now we know we need to save $288,815 in today's dollars. If we multiply that by our savings factor, again, based on a 7% annual rate of return, that means we need to save every year $11,495 to meet our retirement nest egg goal to help fund your retirement. So, can you afford to retire? Those numbers are probably scary to a lot of people. It's common. But the key is now you know. Now you've laid the groundwork for what you need to do to start funding your retirement. The reality is only 23% of pre-retirees feel very confident that they'll have enough money for retirement. Take actions now, start the ball rolling, start small, and add to it periodically, whether that be weekly, monthly, annually. Do something now. So we've done some calculations and we've determined how much money you'll need to have saved up in order to live comfortably during retirement. Now let's look at where that income is going to come from during retirement. It's estimated that Social Security will provide about 42% of income for those aged 66 and older with incomes of at least $51,795. So what does that mean? That means that you are personally responsible for the other 58% of your income during retirement. So let's look at some different ways to help you provide that income during retirement. Specifically, personal retirement plans. You might know these as an IRA or a Roth Ira. These are separate from employer-sponsored plans like a 401k you might be familiar with, or a 403b perhaps. So we'll go over the different types of vehicles, investment vehicles you can use to help provide that income during retirement, including self-employed plans and annuities. So let's take a look at traditional IRAs. These have been around the longest. They're available to anyone, regardless of age, as long as you have employment income. That's a key. Contributions may be tax deductible. What does this mean? It means that if you're eligible, and just to use an example, let's say you make $30,000 per year, and then you contribute $5,000 to your traditional IRA in the calendar year. Technically, you have up until April 15th. $5,000 contributed, you get to reduce your taxable income for that tax year by $5,000. So really, when you file taxes, you're claiming $25,000 of taxable income versus $30,000. It's a big benefit. It's tax deferred growth. What does that mean? That means inside of the IRA, the earnings grow without being taxed. That's a huge benefit. On the flip side, during retirement, when you start to withdraw money out of the traditional IRA, you then will pay income tax on the money that you take out. The IRS wants their tax money, since you got the tax break up front, they're going to tax it as income on the backside of it. There's also what's known as required minimum distributions, or otherwise known as RMDs, with traditional IRAs. What this is when you reach the age of 72, the IRS starts to require you to take out a percentage of the funds in your IRA. Why do they do this? Again, the money went in tax deferred. They want their tax money, presumably before you die. So that's where the RMD comes in. But if you use a financial professional, that's their job to take care of that, to make sure that you know the amount that you need to take. If you do not take the required minimum distribution, the IRS gets really happy because they get to penalize you 50% of what you did not take out. So it's important to keep an eye on that before the year ends. Today, the maximum that you can contribute to a traditional IRA, if you are 50 or younger, is $6,000. If you're 50 and older, you get to do what's called a catch-up contribution, which is an additional $1,000. So if you're 50 and older, you can contribute up to $7,000 per year. If you're 50 and younger, you can contribute up to $6,000 per year. There is what they call phase-out limits for traditional IRAs as well. And you can see here on this chart, depending on your income and whether you're married or filing single, if you participate in an employer plan, such as a 401k or a 403b, and you make $65,000 or less, you still get to deduct 100% of what you contribute to your IRA. If you're a single filer and you make between $65,000 and $75,000 a year, you don't get to deduct all of your contribution, but you do get to deduct some of it. And then if you make $75,000 or more and participate in an employer plan, you can still contribute to an IRA. You just don't get the tax deduction up front when you make the contribution. And you can see the phase-out ranges there if you're married and filing jointly. The good news is if you do not participate in an employer plan, it doesn't matter what you make, you still get to deduct the full contribution to your IRA. And again, if you work with a financial professional, which I highly encourage, that's their job to know all that and walk you through that. So what are the tax savings by contributing to a traditional IRA? You can see here that if you are in, say, the 32% tax bracket, and you contributed throughout the year a total of $6,000, well, because you get to deduct that from your taxable income, your tax savings for that year is actually $1,920. That's a huge benefit when you get that tax break up front. If you're in the 32% tax bracket, and let's say you're over the age of 50, and you maxed out your contribution of $7,000, your tax savings that year is over $2,200. So really something to consider if you're looking to reduce your taxable income for the year, maybe save a little bit on taxes. A traditional IRA might be appropriate for you. Now let's look at Roth IRAs. These are newer than traditional IRAs, but they have some differences and some different benefits than the traditional IRA. With the Roth IRA, the earnings grow tax-free, just like in a traditional IRA. The growth inside of the IRA grows tax-deferred. The big difference there is when you take the money out during retirement, that money comes out tax-free, assuming they're qualified distributions. You don't owe any income taxes on those distributions. Well, why is that? Because in the year that you contributed to your Roth IRA, let's say you maxed out and contributed $6,000 to your Roth IRA, you don't get the tax deduction up front that year like you would on the traditional IRA. The benefit is on the flip side, that money grows tax deferred for 10, 15, 20 years, and then during retirement, when you start taking money out of your Roth IRA, it's tax-free money. You've already paid the taxes up front on that money. Another difference with a Roth IRA compared to a traditional IRA is there's no required minimum distributions, the RMD. Since you've already paid income tax on that money up front, the IRS doesn't require you to start taking money out when you turn 72. So theoretically, if one of your goals was to leave an inheritance to some heirs, perhaps children, nephews, nieces, a Roth IRA could be a vehicle to do that since there are no required distributions depending on your age. You could leave it in there and pass it on to beneficiaries. One of the downsides of a Roth IRA is there are restrictions on who can participate, who can contribute to a Roth IRA. If you look at the slide here, if you're a single filer and you make less than $124,000, you are fully eligible to participate in a Roth IRA. You can max out either $6,000 or $7,000 per year, depending on your age. However, if you're a single filer and earn between $124,000 to $139,000, you're only partially eligible to participate in a Roth IRA. You can't contribute the full $6,000 or $7,000. And unfortunately, if you earn more than $139,000, you're not eligible at all to participate in a Roth IRA account. And there are penalties involved if you do earn more than that and contribute to a Roth IRA. So again, if you work with a financial professional, and you should consult with your accountant or CPA to determine you are eligible to participate in a Roth IRA before doing so. You can also see the phase-out limits if you're married and filing. If you earn more than $206,000, married filing jointly, you're not eligible to participate in a Roth IRA. So when determining whether to participate in a traditional IRA or a Roth IRA, there really isn't a wrong answer. The important thing is to pick one of them and stick with it. Typically, we like to believe that the longer you have until retirement, the more beneficial a Roth IRA might be for you. But again, there's no right or wrong answer. The key is to start one and do one. Again, if you have work with a financial professional, I would recommend sitting down with them, talking it over, and figuring out which vehicle might be the most beneficial and the most appropriate for you. The next retirement vehicle that you could use is an annuity. Now, an annuity is an insurance-based retirement savings vehicle. And because it is an insurance product, there are some bells and whistles that go along with it, but they are also very complicated. So I want to stress that while it could be appropriate, it's important to know what you're buying before you buy it. There's tax-deferred accumulation with the money you put in there. You put money in there, you don't pay taxes on it as you grow. You can contribute an unlimited amount of money into an annuity. There's no limits like a Roth IRA or a traditional IRA. There's a guaranteed death benefit with most annuities, meaning if you were to die before you started taking income from the annuity, your beneficiaries would receive the amount you've put into the annuity minus any distributions that may have occurred during your lifetime. There's also a choice of payout options, whether you wanted to do it based on a single life yourself or maybe on a joint life with your spouse. And additionally, when you begin taking money out of an annuity, the entire portion isn't taxed. The earnings portion is only what's taxed as ordinary income. I should note, with annuities, along with Roth IRAs and traditional IRAs, there's what they call a premature distribution penalty that you need to be careful of. If you are under the age of 59 and a half and you begin taking money out of an annuity or an IRA or traditional IRA, the IRS will penalize you 10%. This money is intended to be long-term money. So when you begin funding a Roth IRA or an annuity or a retirement vehicle of any sort, think of it as long-term money. You're not going to access this money for 5, 10, 15, 20 years. You can access it if you need to, but they discourage it, and the IRS does penalize it with a 10% premature distribution penalty. Back to annuities, there's really two different types of annuities. With an immediate annuity, this is assuming you're near or at retirement and you want to turn on the source of income right away. So in this example, let's assume you take $100,000 of money you've saved up and you put it into an immediate annuity. And the immediate annuity has a presumed 4% rate of return, and it's estimated that you're going to live for 20 years during retirement. That insurance company, assuming that they are in good standing and able to make the payouts to you, there's no guarantees, there's no FDIC guaranteed with an insurance company, but assuming they're in good standing, at age 65, over the next 20 years, that annuity will pay you $7,400 a year of income. That's an immediate annuity. The other type of annuity is a deferred annuity. And a deferred annuity, you can contribute to this over time. This is long-term money where you're getting tax-deferred growth with the assumption that at some point during retirement, you're going to tap into that growth and turn on a stream of income. That's the difference between an immediate and a deferred annuity. So what types of investments can we use to help the annuities grow? You can use individual stocks, bonds, balanced strategy, a mix of stocks and bonds, money market accounts, very liquid accounts, or fixed accounts. So some of those fixed accounts will have guarantees on them on a guaranteed rate of return. But again, it's important to first find out what your objectives are. State your objectives, and then you can build your asset allocation and what types of investments that you want inside of your variable annuity. The next chart shows how investors have typically allocated their variable annuities. Now, this could change based on your stage in life, how long you have until retirement, or economic and market cycles. But as of this survey in 2019, it shows that investors put about 41% into a balanced strategy inside of an annuity. Again, that's a blend of stocks and bonds, and maybe perhaps a money market as well. So it's a blend of all the different asset classes. 30.7% in equities, and that's some version of stocks. It could be in mutual funds or ETFs, and 10.4% in bonds and money market funds, and then about 18% in fixed accounts, which typically tend a little bit more conservative, but they have, again, a guaranteed rate of return. So those is a brief summary of annuities and the ins and outs of how those work. Next, we're going to go over employer-sponsored plans, the different types, and how they work. Now let's take a look at the different types of employer retirement plans. Some of these you might be familiar with, some others not so much, but we'll cover the basics of some of them. There's several different types of employer-sponsored retirement plans. One of the most well-known ones, which I'm sure you're aware of, is a 401k plan. And as of 2020, the maximum that a person under the age of 50 can contribute to a 401k plan is $19,500 per year. Now, employers also have the option of making a match to your contributions to your 401k plan. It's not required, but a lot of them do as sort of an incentive to employees. And employers also get a tax deduction for matching contributions. I will say that with employer-sponsored plans, if the employer does decide to make a match, it's really important that you contribute as much as you can to capture that employer match. Otherwise, it's kind of like leaving free money on the table. The next retirement plan is a 403b plan. This is very similar to a 401k plan. However, these are mostly used by 501c3 companies, nonprofits, schools a lot of times will use a 403b plan. Again, you can see if you're under the age of 50, the contribution limit for 2020 is $19,500. If you're over the age of 50, again, you get the catch-up contribution, and you can contribute a total of $26,000 per year. And again, the employer has the option of making a match to your contribution, but you have to participate in it to get that match. The next retirement plan option is the Esop, or Employee Stock Ownership Plan. This gives companies and employers the option to give shares of the company to employees to kind of reward them or incentivize them, gives them a little bit of skin in the game as they work there. The next one is a money purchase plan. This is funded entirely by the employer, and they have a stated percentage contribution that they have to make every year. The maximum that they can put in 2020 is $57,000. And again, all of these contribution limits, they get recalculated every year. Sometimes the IRS will announce that they've raised the contribution limits sort of as a way to keep up with inflation or cost of living. Sometimes they'll leave the contribution limits the same. But keep an eye on that as we go from one year to the next. Maybe the contribution limit has increased. The next employer retirement plan is a profit-sharing plan. Now, employers who utilize this are not required to share profits with their employees, but if they have a profit-sharing plan, they have the option to. Let's say they've had a banner year and they want to share some profits with their employees. They can do that through a profit-sharing plan. And the last one listed here is what they call a simple plan. A simple plan is just that. It's similar to a 401k and how they operate, but they're intended more for smaller companies. In fact, they're targeted for employees with 100 employees or less. But again, the employee makes the contribution to the simple IRA plan, and the employer makes a matching contribution to the simple IRA plan. But you can see there that the contribution limits are much lower on a simple IRA as they are with a 401k or a 403b. So, if you're lucky enough to work for an employer who offers an employer retirement plan, consider yourself lucky. That's a very good thing that they offer. If they offer a match, take advantage of it. Don't leave free money on the table. So how do you manage your employer plan? Well, One thing to do is keep an eye on exposure to company stock. If you're allowed to buy and own shares of your company stock inside of your retirement plan, that's great. But make sure that you're not betting your retirement successfulness on one single company. We've all probably heard of Enron and what happened there. You might have a really great company and does really well, but don't put all your eggs in one basket. Spread out your investments through different companies and different allocations. The next is to understand the variances in target date funds, otherwise maybe known as life cycle funds. A lot of employers have these with a target date fund. It might say target date 2045. What this means is that based upon your age, you envision yourself retiring at or around the year 2045. So what this does is, if this were the year 2020, that allocation mix will probably be a little more aggressive today. And as you get closer and closer to that retirement date of 2045, that strategy, that target date fund, will automatically get more and more conservative as you approach that date. You don't have to do anything. It's very hands-off. But those are how target date funds. And as you reach the year, let's say 2045, your retirement date, but you decide to work a couple more years, that's fine. Those funds still stay invested. They'll just be invested more conservatively. Choose more than one fund option and diversify your holding. You've all heard the term diversify, diversify, diversify. It's important to spread your investments out over different investment types, different allocations, and to really monitor those over time, because as performance changes, one investment have done really well, which is great, but now it might be too big a piece of the puzzle, and you've got too much exposure to any one investment. So diversification is great, but monitor those and reallocate as necessary. And as I said before, take advantage of company match if it's offered to you. It's a great benefit. It's free money. Take advantage of it. And I always tell people, if you're not sure where to start with something. Start small, a dollar amount or a percentage you're comfortable with, and then review it every 6 months or year. And if you're comfortable with it, bump your contribution up a percentage point. So let's take a look at how employees are investing their retirement, their 401k dollars. In this survey from 2018, you can see that target date funds are extremely popular. They're one of the most widely used investments inside of employer plans. 38% of those surveyed use target date funds. 35% use equity funds or stock mutual funds, which we'll get into a little later. 8% in bond funds, 2% in money markets, and then you have some other strategies like stable value funds or company stocks. So a good blend there. Again, there's no right or wrong. Everybody's different. You just need to determine what's appropriate for you and what you're comfortable with. So now we've talked about employer plans that might help fund your income during retirement. Let's take a look at Social Security. What can you expect from Social Security? Well, you can take it early. The full retirement age is increasing as changes are being made to Social Security. But currently, if you started taking Social Security benefits early, let's say at age 62, which is the earliest you can turn on Social Security, your monthly benefit will be permanently reduced by 25 to 30%, depending on when you were born, how old you are. So they really encourage you, it's really beneficial to postpone taking Social Security if you can in order to get a larger benefit. If you waited until full retirement age, ages 66 to 67 currently, you're entitled to 100% of your full Social Security benefit. If you're in a position where you can afford to wait even longer and put off taking Social Security even longer, you can increase your benefit up to 124 to 132% of your full benefit based upon your year of birth. And Social Security can be tricky. If we had a crystal ball and knew exactly how long we were going to live, I could tell you when the most appropriate time would be to turn on Social Security, to make you get the most benefit while you can. Unfortunately, we don't have a crystal ball. There's no guarantees in life. So we really need to sit down and figure out what's the most appropriate for us and when we should start taking Social Security. Because again, not everybody's alike. Everybody has different things going on. The next chart here shows the maximum Social Security benefit you can receive. If you turned on Social Security at the age of 62, you started it early, the maximum amount you can receive in 2020 is $2,265. That's per month. If you waited until the age of 66, full retirement age, to turn Social Security on, your benefit increases $746 per month. The maximum amount you can earn is $3,011. If you can postpone taking Social Security even longer and waiting until age 70, the maximum length of time you can wait, the maximum monthly benefit you can receive is $3,790 per month. Now, again, that's based upon your wage earnings history, so everybody's different. But the maximum you can receive at age 70 is $3,790. So now you're getting some facts and figures. You can really sit down and say, okay, if I waited until 66, this is what it would look like for my retirement income. Can I afford to do that? Or do I need the additional income source and I retire early at 62? Should I turn income on at 62? And again, if you work with a financial professional, that's their job, is to sit down with you and really go over those and figure out what's the most appropriate for you. So what are the expectations versus reality with Social Security? Well, based on a survey in 2019, only 30% of workers expect Social Security to be a major source of retirement income, when in reality, Social Security is a major source of income for 59% of retirees. So there's a big difference there between reality and expectations. So is Social Security falling short? I'm sure you've heard it in the news. The talk is, will it be there for me when I retire? Me personally, I've got years to work still. I'm trying to save as much money as I can for myself so I don't have to rely as heavily on Social Security during retirement. But again, Social Security wasn't intended to be a fix-all. It wasn't intended to meet all of our income needs during retirement. Based upon the higher cost of living these days, higher salaries, Medicare premiums being deducted from Social Security, and taxes on Social Security, we really can't rely solely on Social Security to fund our income during retirement. So speaking of taxing your Social Security benefit, many people don't realize that a portion of your Social Security benefit could be taxable based upon your earned income. So if you're retired and let's say married filing jointly, and your earned income during the year was between $32,000 to $44,000, well, 50% of your Social Security benefit could be taxable. Now that's not a 50% tax. That just means that your 50% of your benefit, Social Security benefit, could be taxable. If you're married and filing jointly and you make over $44,000, 85% of your Social Security benefit could be taxable. So what does that mean? If you decide to continue working during retirement, or maybe you find a part-time job that you really enjoy, that's great. But just keep in mind what effect that income from your part-time job might have on the taxation of your Social Security benefit. And I really encourage people to, as they approach retirement and have Social Security questions, set up an appointment with the Social Security office in your town or the town nearby. They're really good about helping you determine how to get the most benefit from Social Security that you possibly can. So far today, we've covered personal retirement plans like traditional IRAs or Roth IRAs. We've gone over employer retirement plans like 401ks and 403bs. We've discussed Social Security. Now let's talk about your own personal investments. And when we get to those personal investments, most people, especially the younger you are, will typically have a shortfall in that category. So let's dive in. First thing to do is find your starting point. Where are you at today? Where is your money? Is it at an investment account with an investment advisor? Do you do it on your own? Or perhaps it's all tied up in employer plans. That's fine, but we need to know where you stand today. And what investments do you own? Everybody should have at least a basic fundamental knowledge of what they own and why they own it. And in reality, we're all running a small business out of our household. So we really should understand what we have, what we're spending, money coming in, money going out, or what most people call a budget. That's a 4-letter word in a lot of households, but it's vitally important to develop a budget as you approach retirement and into retirement so you can keep track of money coming in and money going out. So what's your investment strategy? Again, it's vitally important to plan before you invest. Figure out what it is, what your objectives are. What are we trying to do here? And to really have an understanding of that before we dive in and start investing our money. So what are some considerations in developing an investment strategy? The first one is figure out your investment objectives. What do you want this money to do? And everybody's different. There's no cookie cutter approach. Some objectives might be retirement. Perhaps it's planning for an upcoming wedding. Perhaps it's college savings plan. Or maybe you just want to leave an inheritance to beneficiaries. Those are all different objectives, but we need to identify them first and foremost. And then once we've identified those objectives, figure out what our time frame is. What's our time horizon? Typically, the longer time frame you have to meet those objectives, the more risk you can afford to take on in your investments. Now, being able to afford that and being comfortable taking on those risks are two different things. The longer you have, the more risk you can afford to take on, but you also have to be able to sleep at night. So if you're losing sleep because you're getting your investment statements and don't like the roller coaster ride of the stock market, it might be a good time to push pause and really take a look at your investments and if they're appropriate for your risk tolerance. Which brings me into defining your risk tolerance. Are you okay taking on risk? Are you more conservative? Do you not like the roller coaster of the stock market? A lot of people in 2008 went through a roller coaster ride. If you were losing sleep during that time, maybe it's time to look at your overall investment picture and recategorize how you're invested. Everybody's different. A 35-year-old is going to have a different risk tolerance than a 65-year-old who's getting ready to retire. So it's important to determine your risk tolerance. Then we need to determine what type of asset classes we're going to use in our investments. There's really 5 typical different asset classes. There's some subcategories in those 5 different asset classes, but we're going to focus on 5 today. The first is cash and cash alternatives, kind of like CDs at the bank, certificates of deposit, or money markets. Very liquid assets, easy to get to, not a real high rate of return, but low volatility and lower risk are involved with those assets compared to the next category, which is stocks or stock-based mutual funds, which we'll dive into here shortly. And with stocks, you have ownership in a company compared to bonds, which is the next asset class, or bonds using mutual funds. Historically, bonds have not offered as high a rate of return over time than stocks. Bonds typically tend to pay interest and a rate of return which could be beneficial to a retiree on a fixed income. And then we move into fixed principal assets such as annuities, which we covered previously. And then you get into tangible assets. This could be things like your house. It could be gold and precious metals or collectibles like artwork. We won't spend too much time on those today. We're more looking at investment assets. So what is a stock? A stock is ownership in a company. If I went out and bought a share of Union Pacific Railroad, I'm technically considered an owner of Union Pacific. I'm buying the stock in the hope that it will be worth more in the future than what I paid for it today. I can look at a balance sheet of a company and determine, okay, if assuming normal market conditions, and there's never normal market conditions, there's always something, but assuming normal market conditions, XYZ company should be worth blank a year from now. And then I can make an investment decision based on those calculations. But I am a part owner of a company. There's different types of stocks or companies. There's value companies or dividend-paying companies. These typically are used by retirees who need a source of income. They're not necessarily interested in growth of the stock. They want the income from the dividend that company pays. The other type of company is a growth company, Berkshire Hathaway is a great example of that. It's a great company. We all have heard of Warren Buffett. They're more growth-oriented. Today, Berkshire Hathaway does not pay a dividend, which is fine. They reinvest those earnings and that money back into the company for growth, which is great if your objective for your investment assets is growth. If your objective is income, say during retirement, Berkshire Hathaway might not be an appropriate investment for you since it doesn't pay a dividend. Again, if you work with a professional, an investment advisor, this is where they sit down with you and really determine what the appropriate investments are for you based on your objectives. So what's a realistic average rate of return for a stock in the stock market? Well, it's varied. Expectations have varied throughout market cycles, throughout history. But going back to 1999, the average investor's expected rate of return was over 18%. That's pretty high. Then we went through the early 2000s and the tech bubble, and the market didn't perform so well. Coming out of that in 2003, investors had an anticipated rate of return of about 8.5%, a pretty big difference from the 18% in 1999. Then again, we went through 2008 and 2009 and the Great Recession, and coming out of that, expectations were hampered. But we've had a pretty good period of growth coming out of 2008 and 2009. Expectations in 2019 were about 8% return for the stock market, when in reality, the market had a really good year in 2019 and had a return of over 31%. In 2020, the rate of return expected was about 7%, and we'll see how we finish up the year. But again, nobody knows, nobody has a crystal ball. You need to figure out what your objectives are and what your expectations are with stocks. Now we're going to dive into asset allocation. And because we don't know which asset class is going to perform best one year over the next, nobody has a crystal ball, it's important to spread your investments out over different types of investment classes. And we're going to discuss different ways to do that here. Many of you are probably familiar with the term mutual funds, but not a lot of people, the average investor, understands the ins and outs of how they work. A mutual fund is a great way, especially for beginning investors, to get great diversification and lower entry costs. So you don't have to have a whole lot of money to start with to invest in mutual funds. There's all types of different funds, from money market funds, income funds, growth funds, international funds, individual sector funds, whether you like technology or healthcare. You can pick them. There's a full universe of mutual funds based on your objectives. So how do we select a mutual fund? How do we know a mutual fund is appropriate for us? Well, back to developing a plan, the first thing to do is identify what your investment goals are. What do you want this money to do for you? The next is determine your time frame. How much time do you have for this money to grow? And then lastly, determine your risk tolerance. How much risk are you willing to take on? And then based on those, you can select a mutual fund based on the mutual fund's objective. If my objective I've determined is growth, I can select from a whole universe of growth mutual funds. Or I probably wouldn't want to own a mutual fund that focuses on income, because that doesn't fit my investment objectives. What you're doing when you're buying a mutual fund is you're giving your money to a professional investor, and they're pooling your money with other investors and going out and buying a range of stocks or bonds based on that fund's stated objectives. Now, it's important to note that if a fund's objective is to own international companies, that is, non-U.S. companies, it doesn't matter what the U.S. stock market is doing, that fund cannot own U.S. companies. So it's important to own different varieties of mutual funds for different objectives. Another form of mutual funds, which is fairly newer than the traditional mutual funds, is ETFs, or exchange-traded funds. You've probably heard this in the news or in commercials, ads on TV, and they've really come a long way since they were first introduced. In the year 2005, there was a total of 204 exchange-traded funds. As of 2019, there's over 2,000 different exchange-traded funds. So they've really grown in popularity. There's several different reasons for that. exchange-traded funds tend to be more passively managed compared to traditional mutual funds. That is, the manager isn't nitpicking day in and day out, buying and selling individual securities inside of an exchange-traded fund. The goal is to more track an index like the S&P 500. So if the S&P has 500 companies, an exchange-traded fund that tracks the S&P can only own those 500 companies. So it's more passively managed, which then also helps to reduce the internal fees inside of those exchange-traded funds, which is appealing to some investors. So again, using exchange-traded funds or ETFs, you're really giving your money to a professional, somebody who's trained in investing, has lots of knowledge, lots of resources, versus doing it on your own and picking your own individual stocks or bonds. We really have to stay on top of it. And I don't know about you, but I have a lot of other things going on in my life. And, I may not have time for another, thing to monitor on a day-to-day basis. So that's why professional management and using mutual funds and ETFs are really beneficial to the average investor. And a lot of 401k plans and 403b plans are using these already. Now let's talk about bonds and investing in individual bonds, whether it be buying them ourselves or through mutual funds. Bonds is loaning money to either a government, a municipality, or a corporation. The example I always like to use is Union Pacific. Let's say they need to upgrade their rail system. They need to raise money in order to do that. They could then issue a bond offering to investors where I would loan them money with the expectation that they will pay me a stated percentage or interest rate per year until that bond matures, where I get my principal back. It's important to know, though, that is not a guarantee. Me getting my principal back is based on the solvency and the health of that corporation or that municipality. If they can't make their interest payments, they will then default on that bond, and I may not potentially get my initial investment back. And so there is risk involved with bonds. They may not be as volatile and up and down as the stock market, but there is risk involved. There's risk involved with every type of investment. There's credit risk involved with bonds, whether the issuer is able to make their interest payments. There's also interest rate risks. And a lot of people don't understand that there's an inverse relationship between the price of a bond and interest rates, or the bond yields. And think of it as a teeter-totter. If I went out and paid $10,000 for a 20-year bond that's paying me 4%, then that same corporation comes out a year later and issues another bond with the same duration, but now it's paying 5% instead of 4%. The interest rate has gone up. The price of my bond paying 4% has actually decreased with the interest rate, because a 5% bond is more attractive to a new investor than a bond that's only paying 4%. So it's something to keep in mind with rising interest rates. If you own bonds and fixed income and we're in a low rate environment, the Fed has not raised interest rates for several years now because of certain economic conditions. But as they begin to slowly increase the interest rates, you'll see the price of existing bonds decrease, hopefully temporarily, as long as that issuer is able to make the interest payment. You should get your initial payment back when that bond matures. And again, the interest rate that an issuer, whether a municipality or a corporation, pays is based on the financial health of that corporation or municipality. Think of it as if you were going to go out and get a mortgage to buy a house or a loan to buy a car. Depending on your credit rating, if you don't have very good credit, that issuer, they might make you pay a higher interest rate just because you're more of a risk potentially to make those payments to that company. The same is similar with the issuer of a bond. If their financial health isn't the greatest, well, they might have to pay a higher interest rate in order to entice investors to take on that risk and buy their bonds so they can raise capital. So we need to really identify what our expectations are for our investments. If we have higher expectations and we don't meet those expectations, we might be in trouble. We might need to save more money or get a little more aggressive with our strategy in order to make up ground. The example here, it shows the downside of high expectations, insufficient funds. If you took an initial investment of $100,000 and invested it over 20 years, and your expectation was an 8% rate of return, that's what you were hoping to retire from, but let's say you only had a 5% rate of return over the long term. Well, that $100,000 is now only worth $265,000 when you were expecting a rate of return of 8%, which would have amounted to be over $466,000. So it's really to keep in mind what our expectations are, what we intend for this money to do, and based on how they're doing, we might need to make some adjustments. Maybe increase the amount of risk we're taking on, decrease the amount of bonds, increase the amount of stocks to hopefully gain a higher rate of return. But keep in mind, in doing so, you could potentially be taking on more risk and more volatility. Conversely, maybe your investments have done really, really well and your retirement nest egg is looking really good. It might be a case where you don't need to take on undue risk in order to meet your retirement goals. And that's a good position to be in, to be able to not take on undue risk in order to meet your goals. But it's important to monitor that through time to determine what your expectations should be. So what does history say? How has rate of returns historically been in the stock market? We all know the stock market doesn't just go straight up. There's ups and downs, there's good years, there's bad years. But if we go back in history and go back to 1990, since then, the stock market, the S&P 500, has had an average rate of return of just under 10% per year since 1990. That's really good. But keep in mind, if you remember 2008, in 2008 alone, the market was down 37% in 1 year. It wasn't fun. But if we're long-term investors, we're not so much concerned about what the market's doing on a day-to-day or a month-to-month or even a year-to-year basis. We're more looking long-term. And if over long-term we can average returns of 9-10%, that's great. But keep in mind, it doesn't go straight up. And I can almost guarantee you that there will be years like 2008 where you will lose money in the stock market. But if you keep a long-term perspective, not worry about what the market's doing day to day, week to week, and look at it long-term, you should be in good shape. So how do we build our asset allocation? There's several steps in order to do this. Assess your current portfolio. What do you have? Is it invested in stocks, bonds, cash? And then determine your investment mix. This is in order to meet your objectives. If you need a higher rate of return, it might be a case where you need to own a higher percentage of equities or stocks. If you don't need a higher rate of return in order to meet your objectives, maybe you own a higher percentage of bonds and fixed income compared to stocks or cash. Again, that's where a financial professional comes in to help you really determine what your objectives are and what's an appropriate allocation mix for you. Then identify the investment types. Should we own individual stocks? Should we own bonds, mutual funds, exchange-traded funds, annuities? And then select specific investments. What type of mutual fund do we want to buy? What stocks do we want to own? Are there certain sectors in each individual industry that we want to own and take advantage of market cycles in? And then the key here is, and most important, is to review periodically. Don't go online and check it every day. You'll drive yourself nuts. But check your investment portfolio periodically. We recommend doing it at least once a year, maybe if not twice a year, just to see how you're doing. And maybe some adjustments need to be made based on performance, or your objectives have changed from before, or maybe a life event has happened. Maybe you've had a child and have some added expenses. Maybe you've gotten divorced. It's really important to do a comprehensive review regularly to make sure that your investments are still in line with your objectives. We've covered a lot of ground today. We've gone over individual retirement plans, employer retirement plans, Social Security benefits, annuities, asset allocation. Now let's look at what the pros do. And they have more resources. They've been doing it longer than we have. How are they successful? Sir John Templeton was a very famous and successful investor. His catchphrase was diversify your investments. There's nothing major about that. We've talked about that. Diversify, diversify, diversify. Don't put all of your investments in one basket because you never know which investment will perform best one year over the next. Warren Buffett. We've all heard of Warren Buffett, the Oracle of Omaha. His saying is, if you don't feel comfortable owning something for 10 years, then don't own it for 10 minutes. Think long term. If the company is healthy and you can see yourself owning it in the long term, then it might be a good investment. If it's not, it might not be appropriate to own at all. Bernard Baruch was another famous investor. His saying was, don't try to buy at the bottom and sell at the top. It can't be done except by liars. The important thing is it's time in the market, not timing the market. Nobody knows when the market's going to peak. Nobody knows when the market's going to bottom. If you're a long-term investor, you're not concerned with that. It's time in the market. There's charts and history and figures that show just missing several few of the best days throughout the year, or 5 years or 10 years, reduces your overall return significantly. So don't try and time the market. It can't be done. So to wrap it up, I want to thank you for spending time with me here today. I know we've covered a lot of ground. I hope it's been beneficial to you. But the key is here to remember that every person's situation is unique. There's no one cookie cutter approach to this. Everybody has different things going on, different risk tolerance, different objectives, different time horizons, different goals. So it's really important to take the time to sit down, whether you do it on your own. I would encourage you, if you don't already, to find a financial professional that you're comfortable with and that you can trust, and sit down with them and really build a strategy and a portfolio that's appropriate for you, and to really work towards helping you meet your retirement, your goals. I would also encourage you to visit the NPERS website. There's resources on the website made available for you. We want you to be successful. So utilize those resources, reach out, ask questions, and most importantly, good luck.